All right, welcome to the first trading plan that we are going to be discussing, which is the stick trading plan. The stick trading plan is mainly based on candle signs. We've gone over candle signs a lot more in depth in this enrollment. I would argue previous enrollment, we go more of an order flow, which leads to a trading plan like Delirium, for example, which we'll also go over later on. But the stick trading plan is purely based on candle signs. I have tested the stick trading plan. I actually have passed a FTMO challenge right there. Feel free to scan the QR code. And I passed it on the 10th of April 2024. And I want to go over the trades that I also took using this trading plan, because this trading plan has been in the works for quite some time right now. And when we look at the stick trading plan, we have three different entry models. The first entry model is going to be the easiest entry model. The second entry model is going to be more difficult, more advanced. So you need to get a good grasp of the first entry model to be able to move on. The third entry model is the most difficult. It's the most advanced one. So my advice would be, if you struggle with already entry model number 1, then please do not move on to entry model number 2, because this trading plan might not be for you. So again, it's all about finding what resonates with you. So these trading plans are purely for inspiration. Just because I passed an FTMO challenge with it, it says a lot, but also doesn't say a lot, because I can use a lot of different trading plans to pass an FTMO challenge in all my humbleness. So right here, find what resonates with you and just take inspiration from it, and then see if it works for you as well. Now we have a few rules right there before we dive into entry models. We have a first rule: bias must be absolutely 100%, no other arguments. This trading plan is a filtering process trading plan. So remember the two foundations. We either have a filtering process trading plan or we have a flow trading plan. This one is a filtering process trading plan. The bias for the stick trading plan must absolutely be 100%. There can't be any other argument. So I must be 100% bullish to even look at the entry model right there. Then number 2, narrative must also be 100%. No other arguments. I must be certain that we are more likely to continue higher off of that certain discount array as well. Then play around news, not mandatory on 1 hour plus entries. Gather data. So this trading plan is quite new, and I have not been trading around, or I have not been mandatory like I do in other trading plans, been trading with news, which is quite interesting. Again, keep in mind, this trading plan is still quite new. So I personally don't even have a lot of data on it. So feel free to gather your own data as well. That's very important. And see, do my trades play out more on news days or not on news days? And then over a large sample size, maybe 50 trades, maybe 100 trades, we can determine truly, all right, news is better for this trading plan. But currently, I have not seen any signs thus far. Again, that's an early statement. Now, number 4, avoid third candles unless no resistance. So when we enter on a discount array on the daily, we do not want to be trading a weekly third candle right there, unless on the weekly we have no resistance as well. Running into an opposing PD array, wait for opposing 2 candle rejection to fill. So when we look at a discount array to continue higher off of, in that context area, we are running into a fair value gap, which you won't see often, but sometimes it does tend to happen. Then we want to wait for that bearish fair value gap to fill based on 2 candle rejection, and then look at a candle signs entry as well. Again, a little bit more advanced, but I'll show you a few examples as well. No clear rejection, wait. Simplest option is always waiting right there. Now let's dive into the entry models right here. Entry model number 1. Again, based on a filtering process. So everything we have gone over thus far, filtering process, you would use that for this entry model, and you would use that for this trading plan. Bias, narrative, context, all again based on filtering process, what we went over thus far. Then the entry is what's going to change, because the entry right here is the same time frame as narrative and the context. So the PD rate that we are expecting either higher or lower prices off of is the same time frame we are going to be using for our entry time frame. So we're not going down time frames in entry model 1 right there. Enter based on 2 candle rejection. Again, I'm assuming you already understand 2 candle rejection as well. 2 candle rejection, first candle rejects, second candle respects. The first candle does not reject and does not respect. Second candle goes through the previous candle low, or can also just simply set reject. Risk management. Risk percentage, use the 5% boundaries, the, again, universal agreements that we went over. Target for entry model 1 is going to be 1 to 2 RR. Stop loss, rejection, unless 1 to 2 RR is far, then use the trap analogy. Break even, expansion phase candle. So I have a few examples right there. These are trades that I actually took for the FTMO challenge as well. So I want to go over them right here. Here on Australian dollar CHF, this is where I took the first trade using entry model 1. And it was the following thought process. So we started off as bias, narrative, and context. Now, when we start off with bias, narrative, and context right here, then if we look at the weekly, the target is overall quite clear. Now, right here, when we pay attention, we can again also use that 2-candle rejection as our bias, right? Because if we want to continue lower, then we have that order block potentially we can continue lower from. Now, right here, we have the first candle, not necessarily rejection, but the second candle is a down candle right there. Instead of actually creating a new down candle on the third candle right there, we respect this weekly fair value gap and we actually continue higher instead. So here, it is no resistance towards this high right there. Okay, that already means that we can potentially trade every candle. Now, I traded this candle right there, that up candle on the weekly, which actually reaches for that high, the drawn liquidity right there. So the bias, narrative and context, we will see on the daily right here. So at the beginning of this week, I was looking at this price action and I knew we were potentially going bullish, but we don't really have a clear discount rate we can continue higher off of. So the only real thing that we have right here is this fair value area and also the swing low that we have right there, both discount arrays that we can potentially continue higher off of. So my narrative and my context here is on a daily time frame. So what do? Entry, same time frame as narrative and context. Now, when you use entry model 1, the rejection on the first candle is oftentimes already an entry. Entry model 1 also has a negative side where you might miss a certain move sometimes because, of course, if it's on the same time frame as your narrative and context, it might just absolutely move away. For example, if you waited for a weekly fair value gap that we sting into, or weekly order block, let's just take that for example, then entering on that weekly candle, we already move higher right there. So we already reached the drawn liquidity. So after that, it's not a good entry anymore. So right here, if we want to enter off of this, usually entry model 1, since it's on the same time frame, your entry time frame as the context narrative, the first candle can already be quite a good entry. Now right here, the entry is then at the close of that candle rejection. This is the close of that first candle rejection right there. It's already rejecting, it's already sweeping. Perfect. That in itself is an entry. Now, when we look at this entry, there's a few questions we need to ask ourselves. So risk percentage, 5% boundary, so I already know what I want to risk. Target is a 1 to 2 RR. Now, of course, to determine my target, the rejection is so the stop loss is going below the rejection unless 1 to 2 RR is far, then use trap. So what does that mean? The drawn liquidity right here is this line. That's the no resistance area. That's the drawn liquidity that we are actually looking to target. So right here, if I want to cover this low right there, do I have an easy 1 to 2 within that overall context area towards that drawn liquidity? Yes, there's no resistance anymore towards the left except for swing highs. Even before this swing high, we have a 1 to 2 RR. Perfect. That is exactly what I want to see. Then I can target 1 to 2 RR comfortably. Now let's say we didn't have a 1 to 2 RR right here and we couldn't comfortably target a 1 to 2 RR. What would we do? If the 1 to 2 RR is far, so it's not within that drawn liquidity, then use the trap analogy. What does that mean? So right here, we are sweeping, and when we enter off of a 2-candle rejection, 9 out of 10 times, we sweep something. We sweep either into a fair value gap, we sweep either the previous candle low, we sweep a swing low like that into a fair value area. So right here, if people are getting involved, and again, use the breakout trap analogy, then right here, people are getting involved. So we do not want to see price come back below that low because that's where people are getting trapped. So if we want to refine our stop loss because we can't comfortably target a 1 to 2 RR, it can be below that low as well. And then we can target a 1 to 2 RR right there. It's very important to understand, if you do not have a good understanding of the rejection, of the sweeps, etc., that stop loss is more often than not going to be not good for you. And you're most likely going to take losses that end up being winners. So first, try to find trades where you can just simply cover the rejection. That's the safest place right there. Now, when we enter, when can we go break even right here? Next rule, expansion phase candle. So as soon as we have an expansion phase candle, and let's define expansion phase candle a little bit more. We have a previous candle high right there on the daily. That previous candle high right there, if we now expand above that and actually create right here a body of a potential fair value gap, we close above that high, that in itself can already be a break even right there, because this right here is the expansion of a new fair value gap. So that is where exactly where I want to go break even right there. There's different scenarios as well, because for example, what if we came above that high and we had a huge wick at the top and we came all the way down? I would still be break even because I would not want to see that retracement. So usually in the next candle in a stick trading plan, you can quite often already go break even right there. Eventually this ends up hitting take profit right there, even before the overall drawn liquidity. And this is the first trade example. Now the next trade right here, and one of the earlier trades as well that I took when I was still sort of refining the overall rules, etc., is Australian dollar, Canadian dollar, the 20th of March right there. Now, right here, I took a break even actually, and let's go over it. Right here, if we take a look at the weekly, we can see that the weekly is coming into that fair value gap, and it's also running into this breaker actually. So based on the higher time frame, if I'm arguing against myself, this in itself is already not the best trade, if I'm being honest. Then we are trading the retracement of that 2-candle rejection. So if it wanted to continue lower, it would have disrespected everything like it did to then continue lower. So this fair value area that you're seeing right there, to continue higher off of that, then that fair value gap, to me is a little bit random. And I would argue this for myself, it's not a good trade. So I want to show you here that this is not super high probability, this higher time frame scenario right here. Now, if we go over the entry, what do we see? When we sweep this potential low right there, we can potentially continue higher off of that. Now, if we want to continue higher off of that, then we have this down candle, nice rejection already. Second candle can be an up candle. Now, at this moment in time, I did not want to enter off of this candle. And the reason being is because right here, we still can create an expansion phase candle, and we do not actually close above this low right there. So again, the trap analogy is not a sweep just yet, not confirmed just yet. So here, I wanted to wait for the next candle. The next candle is a nice close above that high right there. This for me is a good entry based on the entry, but all the steps before, bias, narrative, context, not good. It's not a good high probability trade. So here, if we now cover this low and cover the rejection right there, then what can we see? We can target a 1 to 2 RR potentially right there. Now, even here, we can refine our stop loss a little bit. If this is our drawn liquidity overall, then we can use a trap analogy right there to indeed place our stop loss below that low that we are actually sweeping. Now, right here, I went actually, and I didn't do that at the beginning, and I actually went break even right there. So we have a long wick right there. And remember, break even, expansion phase candle. But oftentimes, or sometimes, we will have an expansion phase candle right there, and we will come all the way back down. When that happens, I want to be out of the trade because we might be sweeping something. And on the lower time frame, of course, that's fair value gaps going higher, but also fair value gaps going lower right there. So that to me is not interesting anymore. I do not want to trade that anymore. So that is where low probability conditions start to set in. When that happens, I want to be break even at least. So as you can see, it was one of the earlier trades where I did not use the trap analogy just yet right there. But the break even rule, that is quite important. Be flexible with that. When you see a candle, huge momentum going against you, go break even as well. There's an advantage of this trading plan. Relatively seen, based on the candles, you can go break even quite early, quite easily as well. Now, from that, I want to move on to entry model number 2 right there. Again, same filtering process, bias, narrative, context, all the same. Entry is where it changes. One time frame below the narrative time frame. So the narrative and the context time frame that we had determined, where mainly we looked at the daily right here on the Australian dollar, Canadian dollar. You don't only need to look at the daily. You can also use the 1 hour, of course. Now, right here, I want to go one time frame below that time frame. So enter based on 2 candle rejection, wait for a little bit more confirmation. Because when you have a daily candle already rejecting, but off that daily discount array, that's quite a lot of momentum with it. Where of course, the more time frames differ from each other, so the more they are apart from each other, daily and the 1 minute time frame are very far apart from each other. So you need more confirmation. So if we're using the daily and the 4 hour, we need a little bit more confirmation. If you're not too certain, it is better to just wait for another rejection. Now, risk management, risk percentage, again, 5% boundaries. Target is a 1 to 3 RR actually. Rejection, unless, stop loss rejection, unless 1 to 3 RR is far, then use the trap or target a 1 to 2 as well. Now, break even, again, same thought process, expansion phase candle. So let's look at this trade right here, CHF JPY. All right, here we are on CHF JPY. And if we take a look at the weekly first, and the weekly can potentially follow through towards this low right here. And I took the trade after we took that low. So we could even argue, is it super high probability, the higher time frame right there? I would agree with you if you said, well, I don't really think so. But if we now go into the daily, and we had a bigger daily fair value gap right there, that up candle, I'm not sure what happened with the broker, but that was a big fair value gap right there actually. And that fair value gap right there, I wanted more confirmation off of. So the more confirmation we got this sweep of that high, we got this fair value gap lower right there. After that fair value gap lower, what did we see on the 1 hour time frame? On the 1 hour time frame right here, we saw another 1 hour fair value gap lower right there. And keep in mind, the overall context is still to follow through all the way towards the lows. So let me see if I can find the price action again, right there. Then these lows is the overall context area right there. So on the 1 hour, we had enough space to potentially target a 1 to 3 RR as well. So right here, we have this fair value gap that we run into. The first candle, not necessarily a rejection. I would argue that right there, I would not be a big fan of that currently, and I would wait for a little bit more rejection. Again, the lower in the time frames you go, wait for a little bit more rejection overall. Now right here, eventually when we continue lower, we see this candle rejection right there, which we can enter off of. So right here, if we want to continue lower, then we can target 1 to 3 RR. And overall, again, it's the same thought process with different rules as well that we had. Now this entry right here is actually entry model 1, but it's on the lower time frame right there. So if you still want to go into the lower time frame, targeting that 1 to 3 RR is again not that crazy, and you can definitely pull that off as well inside the bigger context. That's my main goal that I want to show you right there. It's inside the bigger context. Now actually before that, I also took another trade, because right here we came off of this 4 hour fair value gap right there. And off that 4 hour fair value gap, we see this candle rejection. Now this candle rejection right here is coming into a different fair value gap. So again, remember the rule that we had right here. If we go back one, we're running into opposing PD array, wait for 2 candle rejection to fill in that opposing PD array. So here, if we want to continue lower off this 4 hour fair value gap right there, and we sting into that, this is 50-50. If we want to continue higher, we can continue higher off that 1 hour fair value gap. So I want more confirmation right there. And when I want more confirmation right here, then we get this down candle, failing the 2 candle rejection for the bullish fair value gap. Because if that wanted to follow through higher, this candle should have been an up candle right there. When that does not follow through, this candle is an actual entry right there. Now this candle is also where I eventually took a break even, because right here, if we do continue lower and we sweep this low potentially right there, again, I would want more confirmation, and I'm not 100% if we do still want to continue lower right there. So that is why that right there is a break even. But this is an example right here, stop loss going above that high right there, rejection. Don't expect a retracement towards that. A 1 to 3 right here to continue lower off of that as well. This right here is entry model 2. The other one that I showed you, also you could argue it is entry model 1. Since it's on the lower time frame coming off of more confirmation areas as well, we could argue it's somewhat entry model 2 because we are targeting a 1 to 3 RR as well. So both is perfectly fine for me right there. Then from entry model 2, I want to move on to entry model 3 right there. And again, it's the same thought process, filtering process, bias, narrative context, all the same. Entry, 1 time frame below the narrative time frame. So it's the same as entry model 2. 2 candle rejection already happened. Enter on non-third candles. So here, entry model 3 is essentially a re-entry, where the drawn liquidity is so clear that we can potentially capitalize on that drawn liquidity without having clear context, without doing anything, and we can just enter based on candle signs actually. Now, risk management, risk percentage, 5% boundaries again, target, context plus the no re. So what is the context area? What's the drawn liquidity? And what is the no re? Why that? Why not a 1 to 2? Why not 1 to 3? That is because right here, we are entering later on. As in, we are entering quite late right here. So the target should also be relative right there. Now, stop loss, no retracement area, break even, expansion phase candle right there. Stop loss, no retracement area. So again, entry model 3 is quite advanced. So if we want to look at stop loss placement, then we should place our stop loss right there where we don't actually expect a retracement based on candle signs. So we really have to think in the future as well. Let me show you a few examples right here. Here we are on GBP US dollar to show you the bigger picture. On the monthly right here, we had potential sweep of that high right there. And we could target the monthly fair value gap that we're seeing right there, which we currently have already reached. So here on the weekly, we had this weekly fair value gap going against us right there, which we can potentially continue higher off of still. Now on the daily right here, on this huge up candle day right there, we had, correct me if I'm wrong, I believe it was CPI or FOMC, one of the two. So right here, we continue higher a little bit. Now, once we continue higher, we come into this daily order block right there, the daily fair value gap, which we have not traded back into just yet. So if we want to continue lower, we can continue lower right now of that daily fair value gap and daily order block. If we want to continue higher, we will continue higher off the weekly fair value gap, but even more precise on the 4 hour, where will we continue higher off of right here? These 4 hour fair value gaps right there. And right here, the highest one. We have a lot of momentum. There's no reason to come all the way back to fair value right there and to eventually not create a daily fair value gap right there. That to me shows, okay, we actually want to continue lower instead. So here on the 4 hour, we already see a first few candle rejections right there. And once we get to candle rejections, we follow through. Now, once we follow through with huge expansion phase candles like that, again, we don't have a lot of resistance anymore. It's happening quite fast right there after a huge volatile day. So this day is also super volatile. Right here, we can follow through on a super clear drawn liquidity. Where here, if we now want to look to target this low right here, that is exactly what we can look to target. A perfect 1 to 3 hour, I entered on this candle right there as soon as that daily fair value gap was not created right there, capitalizing on the move lower. And quite important, my stop loss right there is at a place where I'm not expecting a retracement towards. And if we do retrace towards that, I am happily wrong. Because if we retrace towards that, most likely we are still going to continue higher or we are going to consolidate. So right here, place my stop loss at the high of that potential fair value gap right there. Entry is on the third candle right here. We already take out this first rejection right there as well. Perfectly fine with this entry to completely run lower. Now, once we run lower right here, after that weekly fair value gap that we just took out and weekly order block, we don't have a lot of resistance anymore. So here we can definitely look to target lower, where the first real area that we come into and we can potentially sweep is this low right there. So the 1 to 3 is easily targetable with that much volatility in the market as well. I want to capitalize on that. Again, this trading plan, and I can see for myself as well, this entry model is a lot more advanced. So if you don't understand when price can run, if you don't understand where to actually place your stop loss, how far we can actually retrace, don't trade this. You're better off with entry model 1 and 2, potentially. Now right here, let's move on to the next example. New Zealand dollar JPY, this trade right here is actually what passed me the challenge as well. Let's go over the high time frame. High time frame, we overall just don't follow through. We potentially sweep this low, so we can now target this high potentially right there. Now, once we look at the daily, on the daily, we don't have a lot of resistance anymore. So after taking out this high, potentially sweeping that, we now continue higher off that fair value gap. And after that, we don't have a lot of resistance anymore. So here, this could be an easy target as well right there. Now, on 4 hour, I already wanted to go into the 4 hour because this daily fair value gap is not relevant to me. I'm expecting, since we have no resistance, that we already continue higher right there. We have momentum, we have the volatility agreeing right there. So I'm expecting already higher prices. Now here on the 4 hour, what can we see? We come back into that fair value area, which is better seen on the 1 hour. And on the 1 hour right here, what do we see? On the 1 hour, we come back into that fair value area. We have a beautiful 2 candle rejection right there, which we, again, can continue higher off of. Now, since it was overall a 1 hour entry and stop loss right here, we could argue it's a little bit subjective, where right here, I was not expecting a retracement towards that. Since we came into the fair value area, the 4 hour right there, no real resistance anymore towards the left as well. So we can already look to continue higher towards the low. I was expecting price to continue fast price action. So this fair value gap, most likely breakaway gap right there. Daily as well, most likely breakaway gap. On the 1 hour right here, place my stop loss below the low. And eventually we continued higher off that target right there. And even context target wouldn't even be too crazy right there. Target that. But then you might have taken a break even right there to then hit the take profit. Now, of course, right here, I didn't get a chance to get break even just yet. So it was immediate drawdown essentially, where there was no expansion candle. There was no continuation higher just yet. So this was not a break even for me just yet. So at this moment in time, it's also a little bit more difficult to go break even because I have to monitor this more. Where right here, once we start to continue higher and we actually start to close with a fair value gap above this high, okay, I'm not expecting a big retracement anymore. So we can already go break even right there after this expansion phase candle right here as well. All right, Australian dollar, New Zealand dollar, right here's the last one I want to show. And this is actually a loss where I think the loss was overall avoidable. It was not really a good trade in my opinion. So right here on the weekly, if we want to continue higher, we don't have any resistance towards this high. So the draw liquidity is definitely quite clear. Now right here on the daily, what do we see? On the daily, we had this expansion right there with no resistance anymore, arguably only this swing high right there. So that's a little bit tricky right there. Now after this, when we potentially sweep that swing high, could it have been a break even? Yes, potentially. My stop loss right here, I was not expecting a retracement like that because I was at least expecting a fair value gap to be created. And off of that fair value gap, continue higher. So right here, this was eventually stop loss hit right there, where it's a bit of a shame because eventually it continued higher as well. But it is what it is right there. It's a great lesson to learn, where arguably it's not necessarily a bad trade, but I think it would have been better if I entered after that swing high was taken as well, especially with an entry model 3 right there. So study this, study potentially what you thought I did wrong, potentially. I might not see it right now. And feel free to correct me as well. Now, these are the different entry models that we have for Stick. Study this the way you want to approach a trading plan. I personally, and of course, again, I personally don't backtest. I don't like backtesting. It doesn't make me any better. It doesn't show me the reality of a trading plan. I don't learn really in backtesting. So hindsight backtesting, yes. So feel free, what I just did right here is all hindsight backtesting, right, of my older trades. So feel free to do that as well. But don't actually start using the replay tool. I would advise, if you want to really get some skin in the game, I would advise buy the smallest challenge you can potentially afford, and then dive into a trading plan like that. You'll learn the absolute most things that I can't even learn you, because you are learning from the mistakes you potentially make as well. When you just start using a trading plan, you are going to make mistakes as well. So don't worry about that. It's very natural. We will filter out those mistakes to then eventually get to a conclusion where we can pass a challenge like that. Now, again, feel free to use this as inspiration as well. And hopefully, if this does not resonate with you, don't worry. We have other trading plans. So you can use this as inspiration potentially, but if it does not resonate with you, you find it very difficult to use candle signs, etc. Simply said, don't use it. We can also focus on order flow or even a flow trading plan potentially. All right, perfect. Thank you.